Hey guys, what's going on? My name is hamishwhodder and we are back with another episode of the YouTube stock portfolio. I believe this is episode 8. And if you're new around here and you don't know what this series is all about, essentially I have a public portfolio on the website Stake Trading, and every month I share updates about how that's going. And then throughout the rest of the month, every single week, we have an episode that comes out where I go through and analyze a bunch of businesses. And the goal is that we will add some businesses to this portfolio over the next few weeks and months, and however long we decide to do this series for. Some good news for us when we're building our portfolio is that the stock market in the US actually went down, I think 3% for the whole market and about 4% for the NASDAQ last night for me. So during the day for you Americans, you're lucky that you get to watch the market during the day while I have to wake up to the bad news or the good news. But anyway, the stock market has been going down. So I kind of hope that it continues to go down a little bit so that some of these investments that we're looking into come into and their price sort of gets a little bit more attractive, and then we can make some investments. So that's basically what this series is about. Last week, we went through Amazon and Google, and we sort of dove a little bit deeper into those stocks and decided whether or not we're going to keep or get rid of them. I think we got rid of Amazon, but we kept Google. It was Apple that we were looking at last week, Amazon and Apple. This week, we're going to look at Google and stamps, and we're going to go a little bit further and see what kind of expected return we can come up with for these businesses. What return would we get if we bought now, and what return would we get if we bought a little bit later and we waited for the stock price to come down. So let's just jump straight into that. Become a subscriber if you enjoy this series and you want to see more. Leave a like if you enjoy the video. But for now, let's jump over to my computer and let's get into it. All right, so let's just start off with Google. And in the previous episode, I only had the 5 years of data for Google, and it completely left my mind that there's two different Googles. There's the Class A and Class C, and I was looking at data for the Class A shares, which it's the same data, but on the website that I was getting the data from, they didn't have the full data in for the Class A shares, and I didn't think to look at the Class C shares for the rest of the years. So I've gone ahead and entered in all of those numbers now so that we have 10 years of data for Google, because of course the company's been around since 2004. Another thing that I should have remembered, but I just blanked at the time. But thanks to whoever, I can't remember what your name was, but thanks to you for making me aware of that, because otherwise I wouldn't have been able to fix that. So thank you for that. But I thought we'd start off with looking at the growth numbers again, because I didn't look at all of the growth numbers, and because I only had some of the data. So let's have a look at that. Over the long term, we can see it's very, very good. 19% or 20% basically in sales growth, 12% in earnings per share growth, 20% in equity growth. That's a really good sign, because generally we use equity growth as an indicator of earnings per share growth. And free cash flow growth at 18%, that's also very good. One thing about the earnings per share is that it has been dropping, and this isn't going to be accurate, actually. I've realized this now, because in their latest year, 2017, their 2018 should be coming out soon actually, but in their 2017 year, they took on a massive tax hit to bring back money from overseas. Because if you remember, the US government changed the tax laws and made them a lot more attractive for companies. And one of the rules was that you could take a small, or not small, but a much less significant tax hit if you brought money from overseas accounts back into the United States. And Google took up that option, and they brought back a heap of money, and because of that reason, their EPS took a hit that year. And that's going to warp all of these numbers, because all of these numbers are comparing against the latest year. So we could actually change this, and instead of looking at this 18 as the latest year, use this 27. We could do that actually. I'm actually going to do that and see what it looks like, and then we can change it back and we can work from there. Alright, so I just quickly adjusted the numbers so that it's doing the growth as if 2016 was the latest year, because remember, so for everything else, so for sales and actually just sales really, because they took that hit from the tax hit, which affected their cash flow, their earnings, and their equity. So it's a bit of a distortion of all three of those metrics. So really only the sales for 2017 is representative of Google's growth. But I've decided that I'll show you But I'll show you what it would look like if it was from 2016, because that's more representative of their long-term growth. And as you can see, it's just been phenomenal. 20% EPS growth, 50% free cash flow growth, 20% sales growth, and they're all very consistent. And if you look at the graph, you can see that they're all sort of huddled together at that same 15 to 20% range here, and they're sort of curving up, which is what we want to see. And considering that their previous year, 2017, was so drastically hurt because of that tax hit, when they produce their numbers this year, actually, we'll have a look at the analysts' expectations and see what they think. Their earnings were hurt so much in 2017 that when they bounce back to 2018, this number is probably going to be crazy. It's going to probably show that they have huge growth. But you can see that the numbers for these companies can be they can be changed dramatically depending on a specific situation. Because if you just looked at Google now and you were looking at this, you might think it's a bad company. It just lost 35% in a year on their earnings. That's terrible. Why would you invest in Google? But if you know the business, then you know that it's not going to happen again. It's a one-time fee and it doesn't affect the value of the business. So I'm actually interested to see. So they're expected on average to do almost $40 per share this year. So year over year, that'll be over 50% growth. Sorry, over 100% growth. So you can see that that's why. Whereas if it was coming from this, even still, it would have been close to 50%. They've done really well this year. They've done incredibly well thanks to that, the reducing of the corporate tax rate and a bunch of other things. But yeah, they're going to do very, very well. So we can say that we're sort of satisfied with their numbers, even though it's going to look like that. We'll just ignore that because these long-term numbers are still pretty accurate, and we'll be able to use those in our valuation, knowing that over recent times this is not accurate, and it's more like it's been like that those long-term numbers pretty much every single year. So we know that these are pretty representative of the growth of the business. But if we have a look at some of the other stuff, we've got their debt ratios, their debt management. They've got so much cash and short-term investments compared to their debt, which is amazing. Their short-term assets, including cash and short-term investments and that sort of thing, is 124 billion. 124 billion. Guess how much debt they have due in the next 12 months? Under 25 billion. So just in that 24 billion, they could wipe out their debt for this year and still have 100 billion on their balance sheet, which is pretty insane. And in terms of all of their debt combined, everything that they owe is under 50 billion. So even if they paid off all their debt today, they were just like, yeah, let's just pay it all off. They'd still have 80 billion in short-term assets. Not even long-term assets or anything like that, just short-term assets, which is really incredible. And that's represented as well in the debt-to-equity ratio, which is very low, which is great, 0.3, because you can see their total debt is about 45 billion, and their total equity is 152 billion, so well above how much debt they have. They're easily able to cover that debt, which is great. If we look at their investment, how well they've been at investing, again, this short-term number is going to be affected because they had that lower earnings number, and ROIC uses the net income or the earnings per share in this calculation, so that's why that's down. But their long-term historical return on invested capital has been great, above 10%, almost 13%. And my guess is that when we get the new annual report comes out, and if they do around $40 per share, then we will see this 1 year ROIC go north of 15%, probably in the 20%. So they're all good on that front. And now we can go and have a look at the value matrix and see what kind of return we can possibly get out of this stock. So of course we need to do some inputs. First is earnings per share. And I'm just going to see what the trailing 12 months is. So the trailing 12 months is 23, but again, as I said, that includes some numbers that I don't really like to use. The year ago EPS, $32. Okay, yeah, so this $32 here is the earnings per share from 2017 if you exclude the tax hit. I remember this because I made a video on this way back when I started my channel. So we can use that 32 as a pretty accurate representation of the prior year's earnings. We could use a forward earnings, but that's probably a bit ambitious. So we'll go with this number here because it's pretty fair, I think. So we'll go 32. We're going to look over 10 years because this business has 10 years of data. And I think we should be looking over 10 years, especially when they've got massive growth over a 10-year period. The current price is $1,081 per share. How much did they get hit last night, actually? Because I'm recording this on Thursday, so this was after your Wednesday, where it was a massive pullback, 5%. Yeah, wow, it lost quite a lot. So, okay, so we can see that the growth rates we've got at the side are between 5 and 26% over a 10-year period. I think that's pretty fair. I think that it's possible that a company like this performs quite poorly. It is possible. I don't think it's going to happen. I just think it's possible. So I think it's good to have some numbers under 10%. And again, I think that, what was their long-term? Their long-term growth is, yeah, so over 10%. I think it's possible that they could do an amazing 10-year period where they do 26%. It's possible. Again, probably won't happen, but it's possible. They're likely to do something in this range. Let's see what the analysts think. Over the next 5 years, they think 18%. So this would be fair if we were going to do this. That would be fair. This 17% here, you'd make about a 13% return if you bought it now, and they had a PE of 28. These PE ratios, they might be a little bit too high, because if the growth slows down, we might see Google with a PE of less than 20, and we might never see it go back up to the 30s. But it's possible, and I don't think it's too unlikely that it would sit in a high 20s position in 10 years time. So you can see that there's a lot going on here, and there are some downsides. If they perform weak, under 10% over the next 10 years, then you're going to have a weak outcome, of course, and they don't pay a dividend. Pretty sure they don't pay a dividend. So you're not going to get anything back. It's just purely in the stock price. Yeah, they don't pay a dividend. So you really need to buy this stock at the right price. So we could go over to our buy zone calculator. $32 per share, 10 years, stock price is 181. So depending on what growth rate we use. All right, so let's go over the 5 years and see what analysts are expecting. Analysts say 17%. The buy price would be under 500. So that'd be another 50% drop from where it is right now. That's a long way, yeah, wow. So what would it take for it to be a buy right now with a 50% margin of safety? Probably something in the 20s. Probably in probably 25. Yeah, about 26%. Yeah, it's about 25.5%. It would be a buy right now. If you have a 50% margin of safety, remember that. So what that means is our estimate would be 25%, but if it could underperform that and we'd still make our return. If it actually does 25%, we won't make 15% per year. We'll make something closer to 22 to 26% per year. So it doesn't have to hit that, but that's got to be our estimation, because we need to have that 50% margin of safety to allow for errors. And as you can see, to make 15%, it only really has to do about 17.5% growth. And I say only, that is still a huge number to ask for a company of its size. The price per share would be $4,500 in 10 years time. So that's 4.5 times what the current price is, which means the entire company would be worth about $3 billion. $3 trillion. So it is a big ask, but it's possible. And it's good to know that there's already a lot of green here before we've had a recession. So if we had a recession and this tanked to in the 750 range, over the next 6 months, and then maybe it might even go further, but let's just say it did that. Now we're seeing some really attractive options here. I mean, we're probably going to match the market average just by it doing under 10% growth, so 9% growth. So that's a really, really good sign that if we were to invest in this, the downside is minimal. If they perform horribly, let's say they do 8% and they only have a PE of 23, we'll still make 9%, which is basically what you will get out of the broader market if you just invest in the US market or the Australian market. And so that's basically our downside, or our worst case, is that you get a savings account return or twice as much as a savings account return at 4%. The upside being if it can do 20% growth and it has a decent PE, it's still liked by the stock market at that time, you can make 25% per year, which means that you're, 4-5xing your money over a 10-year period, which is quite a lot. If you make a $10,000 investment and in 10 years time it's worth 50, that's crazy. If you do that a few times over your lifetime, do that 5 or 6 times over your lifetime, you're going to be a millionaire. So it's pretty insane. So I'm actually really liking Google. I'm going to change this to a green because I'm starting to like it. I put it as a yellow originally because, again, I didn't have those numbers, but now I do, and I really like it. And there's clearly a reason I spoke about it when I first started this channel, because I was really interested in it. And I've actually been invested in Google before. I believe I bought Google. Whoops. Sorry about my phone having the loudest vibration of all time. I believe I bought it in the 950 range. Must have been back here. Yeah, it must have been over a year ago. Yeah, it must have been just over a year ago. I think it was back here somewhere, back near the end here, just below 900, and I sold out at 1100. I think, yeah, that's right. I sold out just before those two big corrections at the start of the year. So I made a decent profit on it, but at the time when I bought it, I didn't really do much in-depth analysis like I'm doing now, and I did some recalculations, and I thought, okay, what could it realistically do over the next 10 years? What, like 18% maybe? And I realized that I wanted to sell it because it was above, it reached its sell price at about $1,100 per share. So I realized that I didn't want it anymore. But I will happily be a Google investor if the price comes down, and I hope it does. And we will continue to look into it, and we might just invest into it anyway, regardless of whether the price comes down, because of course I don't want this portfolio just to be stagnant. I want to actually do something in this portfolio. But yeah, I think that's enough about Google for now, so we can go over and have a look at Stamps. Now remember, Stamps had some amazing numbers, but my problem with Stamps is that I just don't think that they might not have a strong economic moat, and that's key, because if we think that they're going to continue this trend of these numbers, they have to have a moat. If their moat goes away, or they didn't have one, they clearly had one. Actually, it's pretty obvious that they had one, because look at these numbers. But if that moat goes away, then this might not continue, and then we can't be confident that it's going to continue. But we'll go ahead and do our calculations. I've already entered it in here. That's right, because I looked at it for my one of my videos. I did an analysis video on stamps.com. But we'll just make sure all the numbers are up to date. So 959 for the EPS. Yep. Looking over a 5-year period, price is 200 now, it's come back quite a lot. That's pretty cool. And let's see what they're expected to do by the analysts. 15% for the next 5 years. Great, cool. So we're looking 5 years out. We could look less, but I'd probably bring these numbers down. Over the next 5 years, again, this looks really, really good. And if they are able to get that new contract with the USPS, and they're able to protect themselves with good deals on sending packages and that sort of thing with USPS, if they lose that contract, their moat's gone, in my opinion. Their moat really hinges on negotiating a good contract with them. But if they are able to renegotiate it, and they're able to continue their growth at 15% for the next 5 years, the outcomes here are very promising. And even if they only do 5% growth, you're still going to get a decent return. So there's not much downside here. Obviously, the biggest downside is that none of this matters, and none of this is accurate whatsoever if they don't get that contract, if they don't have a moat. But we could gamble a little bit on the fact that they will get that contract. I don't do that personally when I invest, but we may do it just for the series. I don't know, just to make it a little bit more interesting. But you can see that their stock price has been getting hammered simply because there's fears about this this contract that they've got to renegotiate, and the fact that the US government via Trump has made it clear that they don't like companies like Amazon and Stamps taking advantage of the US Postal Service. So there's a lot of worry there, but we jump over to the buy zone calculator and we chuck in the current price, what kind of growth would we have to estimate in order for this to be a buy? So it's looking like it's going to be north of 20%, really. Okay. Yeah, so it's about 22% growth or 23% growth, which we would have to assume 23% growth each and every year for the next 5 years in order for it to be a buy right now at the current stock price. Let's have a look what they've done. So in the past 5 years, they've done 35% equity growth and almost 30% EPS growth. So that's in line with what they've done previously, and it's even in line with what they've done over a 10-year period, which we would have to assume a much lower growth rate over a 10-year period in order for it to be a buy. Well, not that much lower. About 19% would be the 10-year number that we would have to use, and that's below all of these numbers here. It's below their equity growth of 23%, and it's below their EPS growth of 35%. So it could very well be a buy right now if we are confident that they can get a good contract and continue to dominate in this space. So that's a big if, and I'll be interested to continue to look into stamps and see what it's all about. But for now, I think that because having a moat is just so important in the investing process, because it determines everything you do from there. Your growth rate that you predict, your PE ratios that you predict, everything that you forecast out into the future is based on the fact that the company continues to dominate. So I'm gonna keep stamps here, but we'll keep an eye out for that moat and see if it stays intact. These other two, Apple and Google, clearly have stronger moats that are not going to go away. Google's moats are not going to go away. They're the industry standard in so many different arenas: internet search, video search, smartphone operating systems. They're leading in AI. There's so many areas that they're leading in and that they have moats in. They're much more protected. And same with Apple. They have their ecosystem. They have their branding. They have their premium products that give them this sort of luxury, sort of exclusivity, sort of style for their customers. That has clearly been a fantastic brand for them and a fantastic moat for them over the past few years. I think Google in this list definitely has the strongest moat. And it probably has one of the most attractive prices, probably has the most attractive price out of all three of these in terms of making 15% per year. Because remember, Apple is so big and they're making so much money that it's unlikely that they're going to continue to be able to grow rapidly. They have in the past, but it seems as though they've sort of passed that peak for them of peak growth. Maybe not, but that's how I see it, and I don't think you can get 15% out of Apple. If we see Google drop 40, 30%, maybe even a little bit more, then I definitely think you can get 15%. I think you can get 25% or more on something like Google, and stamps. We'll have to look a little bit deeper. But yeah, that's what I wanted to do for this episode. I just wanted to go through the value matrix and sort of discuss what we're seeing in the value matrix and whether it's accurate and whether we can trust it and that sort of thing. Next week, what will we do? Next week, actually, I'm going to go through and talk about the integrity side of the management team. So we haven't really spoken about this. We've spoken about skill when we're looking at how they invest their capital and their debt, but we haven't spoken about their integrity. So how we can see if they have integrity. So I'll go through and talk about what I do for that next week, and we can continue to look at these, and if we find something we don't like, we'll knock it off. Otherwise, we may go ahead and make an investment in one of these businesses. But I hope you guys enjoyed watching this episode. If you did, make sure you leave a like and let me know your thoughts down in the comments section below. If you're new around here and you enjoyed this and you want to see more, make sure you subscribe. These episodes come out every single Saturday in Australian. That's Australian time. And I also bring out individual analysis videos on Tuesdays and then a bit of a random video on Thursdays, depending on whether there's some news topic to talk about or something I want to do specifically that day. But that's all that you can enjoy if you become a subscriber. So please do if you're interested. And I hope you guys have a great day, and I'll see you guys next week.